Hello, everyone. Um,
Oh,
we are here to talk about earning safe passive income with DeFi, a topic of great interest to everybody who likes money. So I think that's most of us. We're here today with three amazing luminaries in the space. We have Gareth Ward from Bumper, and Tim Frost from Yield App, as well as Alex from Swissborg, one of the OGs in the space. I consider 2019 to be quite OG at this point in DeFi. So I'm hearing that the sound might not be great. So give me a sign if the sound is not great. But let's go ahead and I'm Lisa Loud. I have a DeFi startup. I'm CEO of Fluidify, which is a startup doing DeFi tools. So this area is of great interest to me as well. And I'm so excited to be talking to these three panelists. Why don't we start by just doing a quick intro? Gareth, you can start us off. Just give us like 10-second, 30-second intro to yourself and to Bumper.
Bumper is a price protection protocol. So essentially, you can bring in an unstable asset. You can bring in an unstable asset like ETH and pick a price that it basically, that you set. Let's say ETH is sitting at about close to 5,000 or so now. Let's say you pick it at 5,000. You protect it maybe 90% of that value, and then essentially if it drops below $4,500, Bumper protocol kicks in and protects that price and that value. So let's say it drops all the way down to 4,000 or 3,000, you could effectively exit the policy and you walk away with $4,500 worth. You got your ETH and some USDC top up, and you pay a premium for that. But the kind of key here is that you're effectively going long on ETH, right? So on that unstable asset. So you then capture the upside. So when it's down, you're protected, and when it goes back up, you're back in that asset that you wanted to be in the first place. So
Right.
it's
Pretty much the
much.
definition of safe, right? You're providing the safety. So really exciting what Bumper is doing. Alex, would you give us a 30-second intro to yourself and Swissborg?
Hey guys, so my name is Alex Fazel, officer at Swissborg. And long story short, we're backed by the community. We've never done a VC round, so we're 100% community centric and driven through governance and through funding. And what we're trying to do is just make DeFi accessible to all. Because to us, more than decentralization, what matters the most is inclusion and getting everyone to be a part of this beautiful world of DeFi. And happy to be here.
Thanks, Alex. Tim, Yield App.
Yeah, absolutely. My name's Tim Frost. Been a fintech entrepreneur, helping to build crypto and fintech companies since 2015. Yield App actually is my third digital banking startup. And what Yield App is, it's a digital asset wealth management platform where anyone can, safely and securely earn yield through crypto and DeFi in a very safe and secure environment
Yep.
through a licensed and regulated fintech company.
Great, thank you. All right, so let's start off by discussing what we are actually talking about here with safe and passive income. What is actually safe? What do we mean by safe? Obviously, anytime you're investing, it's not 100% safe, usually. Even if you keep your cash under a mattress, your house could burn down. So there's nothing that's 100% secure. However, when we're talking in this context about safe and passive income, let's define the terms. What do we mean in this case by safe? And I suspect there may be some different opinions on this. I've listened to some of your talks, all of you, and so I think there's some different opinions on what safe and passive actually means here. But Tim, let's start with you. What do you define as safe income in DeFi?
Yeah, I think that's quite a hard thing actually to define. I mean, I think by the nature, I don't think it would be considered really safe by conventional standards to traditional kind of investments. This passive income, this is such a big narrative, right? And I think something that's very promising for the future of DeFi, but I think just as it's so new and premature. And when you think of passive income, this is something you want to leave for kind of weeks, months, and years, right? In kind of a position and let your wealth kind of accumulate over time and continue to compound. And I hard found to find really positions in DeFi that you right now could comfortably leave your capital in for a few years. So I still think that's kind of being defined active as we go along. But the crypto world, I think, feels overall that if you can leave your capital into a pool for a week, that's pretty safe and secure and passive income.
Mm-hmm. Right. Any responses to that, Gareth and Alex?
Yeah, I think Tim had some really good points when it comes to passive income. And whenever there's an incentive, there's always a risk. There's no such thing as not having a risk. And I think it's very important for us now that we have opened this world of DeFi for all, it's very important for us to understand that there are two core risks. One is a technological layer, and the other is a financial layer. And even the AAA platforms, as we may call them, like the Aves and Curves and Compounds of this space, all represent a certain level of risk. And perhaps we can dive deeper into what are the different, risk return specific asset classes or sections. But yeah, that's an important part to understand is that, and also understanding one's risk appetite, understanding that you could lose all your funds, and even the most well-known audited, companies, by the best auditors in the space have actually been hacked or victim to exploit. So it doesn't mean that you have cool peer reviews. It doesn't mean that it's been audited by two firms that there are absolutely no potential hacks or exploits. So there's risk everywhere, and it's very important to identify that.
Let's say you had a friend who wanted to invest and they are not crypto savvy, but they do have the ability to absorb some risk, to absorb some loss, and they want to experiment. What would you recommend? How would you recommend they divide their portfolio to have some in passive, some in maybe higher risk? Like, what would you recommend that they do to start?
Yeah, I would start kind of extremely conservative. I mean, obviously, learning the fundamentals of private key management, how to set up your MetaMask account and how to properly back up your keys. But then I think the easiest way into DeFi is just to go into some I would say some of the basic backbones of the DeFi landscape, and a balancer pool, a curve pool, kind of etc., and just really kind of low risk, safe, secure, time tested different protocols.
Right.
Yeah, I would say it obviously depends on your level of experience, but assuming you're new to investment, financial portfolio strategies, I always think a really simple way of looking at it is just a three-tier structure. So it's your high, medium, and low risk, and just make sure that you're putting in less into the higher risk, and you're kind of bulking out your low until you feel more confident. Then you can switch those balances around. So your high risk plays, certainly in DeFi, it will be your kind of very exotic kind of abracadabras and minting mem, putting into ETH pools, minting mem, kind of doing that rinse and repeat cycle, and that gets really tricky. So that's something that you'd need to build up to. Your mid plays are your kind of simpler, maybe a promising protocol where you can put stablecoin into and just farm, that coin and just keep selling it each day or whatever, like a mirror or something. And then you're simple, and probably where you should be kind of really thinking about more a protection layer is putting into those kind of bigger platforms that look after your kind of yields. They're doing the hard work behind the scenes, and you're just sitting back and receiving those kind of rewards. You know, the Swissborg of well are really good for that, and all those kind of bigger names. So, and then obviously, like we certainly with Bumper, you could just kind of protect any one of those just to give you that added layer of comfort and to play around in some of the other more exotic places and kind of feel a bit more comfort. So there's certainly a simple strategy to start off with, but you do need to understand that if you're going to play in crypto and DeFi, the more active you are, the safer it will be in terms of management. It's hard to talk about passive income in a truly passive way where you sit back and leave it.
And Lisa, if I
Yeah.
can piggyback on that, there's a really good point that Gareth made is just start with a stable coin. Because even Bitcoin, despite its track records, people are still afraid. They're still like, this is not real money, this is funny money, and all that kind of stuff. So exactly what Gareth said. So this is how I see the risk reward ratio. If you're a beginner, you start with a stable coin. There's some stable coins like USDC that are regulated, they're audited, and you just earn that yield in a stable coin, and then you can just use those yields to buy Bitcoin or Ethereum, right? Because these are the most
Right.
tested, these are the most legitimate cryptocurrencies out there. I mean, Bitcoin is the mother of all cryptocurrencies. So simple stable coin, and with the yield, you then get a position into Bitcoin. And that way you don't lose any money. It's the absolute lowest risk possible. And when it comes to the layering of the risk, like just like Gareth was saying, I think it's very important that obviously proof of stake, for instance, is the lowest in terms of risk because you just delegate your tokens and you can earn yield off that. It's a bit technical in terms of actually doing it, but proof of stake and earning yields off a blockchain is probably the lowest in terms of risk. And then, as Gareth was saying, if you go on DeFi platforms, you choose the AAAs and you only do lending. You don't put it in a liquidity pool and you don't layer it. That's one important part. So just DeFi lending, and then use those tokens that you earned to get a position into crypto. And then if you want to
Right.
go a little bit more into risk, then you have the AMM pools, as you know, and then you can go up to farming, right? So it's really understanding the different risk levels. But I think what Gareth said is a really good strategy.
Yeah, and not that we're giving investment advice, but that is a really good kind of high level kind of strategy. Is I like what you said, Alex, is getting stable coins and then taking the yield from those stable coins and buying Bitcoin or ETH or something. It's actually something that I think a lot of people could get behind because yes, they don't know about this crypto, but if they're taking free money anyway that they wouldn't have gotten paid by a bank from interest, and then they're putting that into crypto, it's kind of it addresses that feeling of uncertainty. It addresses that feeling of wanting to be safe because it's free money anyway, and people are willing to gamble with free money. Yeah. So and then so that's a really good strategy that Alex laid out. Are there other strategies that are interesting from a safety or passive perspective that besides the ones that Alex laid out? We had the stable coins and then buying crypto with it. That's less of a DeFi play. We had the proof of stake blockchains, probably the least risk, and then we have some highly rated liquidity pools where you can earn fees on trading. Are there other ways? What about incentives? What do you guys think about incentives? Is that a safe and passive way?
Sorry, what was that? The
Incentives. So, for example, it's yield farming, but not exactly. It's like if a new protocol comes out and there's an opportunity to earn incentives, do you consider that part of the safe passive portfolio strategy?
I think no. It's still active. I mean, this is my opinion that as soon as you're again back to kind of something Alex was saying, you got to remember there's stable coin and you can get it yield farming, and that's probably one of your safer bets. Really, you're just. I mean, I say that, and the US dollar is not actually that safer bet these days, but essentially that's your safer bet. Then you've got your kind of tier one, two, three of your cryptos, Bitcoin being up there to kind of tier one, and then your bigger altcoins, and then right down to your kind of smaller alt. As soon as you're playing in altcoins, You can hear me? As soon as you're playing in altcoins, you need to appreciate that this is no longer a passive, safe play. So you do need to put mechanisms around you to protect that, or protect by offsetting that risk into other areas, be it a pure protection play or with a third party. So I think even though there are incentives, you're still getting the incentive in an altcoin that is probably relatively illiquid, is still new, and highly volatile.
And I think, Lisa, if I can add just one on what you said about incentives, just like Gareth said, so the stable coin and lending is probably a good way to start. But then you also have, for, as you mentioned, AMMs, automated market maker pools. You can also have a pool where it's two stable coins together to avoid the impermanent loss. So that could be another strategy. But also, Lisa, I think what you said in terms of incentives, if I understand well, is just participating, like trying out the beta versions of Uniswap, trying out the beta versions of the DYDX. These are incredible. Like DYDX did an airdrop that's worth over $1 billion as of today. And they're just incentivizing people who tried their beta versions, who tried their platform and ecosystem. So just being a part of it and testing out the platforms may give you some great incentives as well.
Listen, DeFi, crypto in general, but DeFi specifically is a really like hostile environment. Like anything, any new technology, the top level people, and that also means the top level kind of bad actors are there in the space. And so, you know, from smart hacks to very clever economic, you know, exploits, it is a hotbed for that kind of activity. And what we have to understand is that DeFi is at this kind of almost like a kind of big bang moment where it's about to rapidly expand in a huge way. We've seen what we think is a huge explosion, but it's on the precipice of something far greater. We're kind of entering a DeFi 2 phase. So the first phase was obviously all your big, you know, synthetics, Compound, Aave, DYDX, all those kind of big players. And there's a lot of really interesting things that are starting to develop. DeFi primitives coming, being developed all the time.
Sounds
This is
good.
moving in a very fast way. So in terms of risks, we're going to be in a very risky area for a while, as is crypto anyway, but DeFi specifically. And we do have to absolutely be aware that there are ways to de-risk, but when you're at that cutting edge, at the very forefront of the DeFi space, you are playing with an extremely risky environment.
Yeah, have you ever been hacked, Gareth?
Yeah, not personally. No, I think I grew up with a you know, parents. My father is absolutely paranoid. Came from South Africa, and I think I've just got this paranoia, and he's into IT security and stuff. So I've just grown up that way. For me, I'm okay, but have had a hack with the business before, which was really the worst moment in your life when you see money draining out in front of your eyes.
Yeah, it
And there's
happened to me
nothing
a
you can
couple
do
months
about
ago.
it.
It seems like many of the hacks, many of them, not all, but many of the hacks have some sort of inside component. Mine certainly did. So, you know, you can lock everything down, but then you trust one person and that it just goes out the window. Tim, I think we have your audio back. Do you want to finish what you were saying earlier?
Well, I mean, if we're covering now the kind of the risk in DeFi overall, I mean, you know, from financial and technical, I mean, we well, I mean, we look at it as a company, when we look at DeFi protocols, we analyze about kind of around 60 data points that we kind of look at, and that's continued to evolve. And I'm sure Alex and Swissborg probably have kind of similar procedures that they kind of go through. And so, I mean, the risks are kind of enormous on all fronts. And, besides obviously the basics from, in permanent loss, and all the dealing with anonymous actors in the space, but it just one needs to have tremendous cautious when
Mm-hmm.
you're thinking of entering DeFi. And the biggest thing is the do your own due diligence, do your own research. And I think that can be overlooked. I mean, so it's this industry moves so fast, and everyone just kind of follows each other so quickly, and it's often kind of sets people up for kind of for hard falls when it does happen.
Have you ever been impacted by a hack?
No, I haven't. And I'll knock on wood on that one. I mean, we take many security procedures. I've personally never had any problems personally or through corporate accounts.
Great. Alex, did you want to jump in on the risk question?
Yeah, obviously. So Lisa, like answering the specific point where you're talking about what are technological risks, the majority come from smart contract risk. But the problem with these audits and actually participating is if you really want to have the best risk reward actual portfolio, you actually need technologists, you need smart contract devs to look into the code, to look into the GitHub, see if it's clean, see if there's possibly like one single like opening where someone can do a rug pull, because it's not just external attacks, right? Some of them are rug pulls. It's just one guy, one dev at one company. He specifically left some sort of vulnerability in the smart contract, and whenever someone uses it, one dev can run away and pass it on to other guys, and they can literally liquidate an entire wallet that way. So it's super scary on the technological side. And then, as Tim was mentioning, the financial side is there are issues like impermanent loss or liquidity squeezes possible, and the volatility. So I guess like just understanding the risk is already one great thing. And then maybe perhaps as a strategy, people can just diversify their portfolio, right? If they're comfortable using some CeFi platforms and they don't want to put the effort. I think Gareth is also stressing another point, because you need knowledge, but you also need the effort to actually farm and go and visit the platforms every day to redeem your tokens you earned and to read them, et cetera, et cetera. If you want automation, if you want safety, a centralized entity may be the better option. If you're more technical and you want to work on this every day, just like gardening your flowers and fruits and veggies, right? It's the same thing. You have to go out and water them, or you have someone to do the gardens for you. It's up to you.
Yeah. I'm going to make a comment on this topic because the tools that Solidify, my company, we're building tools to make it easier to do DeFi investment. And part of it, and I get asked quite often, will I be able to set it and forget it? And we have alerts, we have the ability to aggregate everything and show you everything at once, show you all of your positions and show you the returns so you can move capital around. But ultimately, I agree with all of you that there's not really a set and forget it. I mean, I use our tools and I'm on every day, at least half an hour, usually 2 hours, checking all my positions. And of course I'm doing it for testing as well, but I notice that when I am successful at trading DeFi, I need to be very much aware of what's going on. I do think that there's a need in the space for much better tools. The amount of time I spend could be divided by 10 if I had all the tools complete that we're building. If they were all there right now, which they will be in a couple months, but right now it's still a lot of tending like a garden. So
but that's how it was for years.
Yeah.
It's only been in the last, I reckon, 2 years in crypto that it's actually become much easier. I mean, now you've got just phone apps, you just send between, even your MetaMask can be on your phone. All that's so much easier. But years ago it wasn't like that. And especially in DeFi, that's just where we are. We're at that very early dev stage. There are a lot of plays that can't be done unless you're a coder. So and things are about to come through, will make all that kind of play much easier.
Right.
But again, with that comes more people in, more opportunity, more money, more opportunity for hacks, more hackers, and the risk continues.
All right. Well, we're going to wrap it up in a second. I just would like to ask everybody to we'll do a quick round robin. And the question that, well, you can add anything that you think we've missed that is important for our audience to hear. And also, the question that I'd like to address is, with the state of things today, before that, we do have a question from the audience if ETH fees are having an impact on the acceleration of adoption. And just let's address that. Let's have one person address that question. Are gas fees important in the adoption? Are they impacting adoption, slowing it down?
Can I take this one, guys? So sorry.
Yeah, take it, Alex.
I just want to say that because Polkadot, it's roughly 50 cents as of yesterday. It's around 15 to 25 cents on Terra. There are tons of alternatives out there, and I really think that is the biggest question of 2022. Is ETH going to be able to hold up with the cross-bridge multifunctional blockchains that offer better speed and also lower transaction fees? That's going to be the big debacle of 2022.
Yep, yeah. I agree with you.
I think it's also the slowness of L2 development that has also given the impetus to, other chains to kind of explode. So it will continue. I mean, we're just having this discussion in our dev roadmap right now about bringing solutions to fees closer, bring them forward, where we maybe had them a bit further down the roadmap. It's just becoming too essential. So now we're looking cross-chain.
Okay, so let's do our round robin. And the question that I'd like to address, unless you have something more important to say, we'll go quickly around, is the difference between crypto trading and DeFi trading. You mentioned, Gareth, that we're very early in the DeFi space. We're a little more mature in crypto. Does it make sense for people right now, today, to start investing in DeFi? Are the returns worth it? Are the risks worth it? Is it worth it to be in at the beginning so that you are there down the line when things get a little more mature? So quickly, let's go around and start with you, Gareth. What do you think in terms of crypto versus DeFi? What would you say?
Yeah, if you're talking about crypto in terms of the simple trading strategy of buying a coin, old coin of some sort or whatever, and just sitting on it, or trading it to a level, absolutely. I mean, you should be in DeFi. You should be using your cash, your your leftover change at least should be working. You should never have it just sitting there. And you've got to look at what else is there, options in the traditional markets. And when you're looking at bank rates of 0.5% and all these top platforms, of which we have a couple of them right here in the room, and all the Celsius and all that of like putting in double digits, it would be absolutely foolish to not be leaving cash, even your personal cash in bank. I know I've done this. I've just moved it into crypto and just getting it working in the proper places. I think there's this massive sea change that's happening. It's not gonna go back. And so best to jump on it now while the yields are higher. They may not stay that long.
Right. All right. So Gareth says go into DeFi. Who else wants to go?
Yeah, I mean, I'll go at this. I mean, it's, of course, it's there's a lot of crossover between the two, but DeFi yields are very predictable, right? Like you can forecast your returns on the different positions that you're going to be in at kind of a very kind of consistent and predictable basis. Crypto investing has been very lucrative, but it's I would say it's almost predominantly driven by speculation. So for the most part, anyone that wants to be entering kind of crypto markets overall, I mean, I do always recommend to diversify a bit, and obviously invest long term in anything you're looking to invest in. Invest for the future, not for tomorrow. Like think long term. But overall, yeah, just diversification is proven to be kind of a winning formula.
Awesome. Thanks, Tim. Alex, what do you say?
Well, I'm a huge advocate of the Kusama and Polkadot crowd loans. I think if you're looking for safety, because these projects are extremely legitimate, they have to be approved by Web3 and parity technologies, but on top of that, they have to be approved by the community in order to actually compete for a parachain. So I think that's one way, and it's not that difficult to just create your Polkadot JS extension wallet, put it as a loan. If you're afraid of buying crypto, this is literally just a loan. So you put a loan, you stake your DOT in KSM. So your Kusama is for 48 weeks, DOT is for 2 years, and you get the tokens of the project plus you get your tokens back. So 2 in 1.
Mm-hmm.
I do think
Right.
this is quite an interesting opportunity, right?
Okay, and I got the green light to take another question from the audience. So I'm going to hit this back over to you, Alex. Since you were just talking, I want to know, can you explain to someone who knows absolutely nothing why it is that you can get a better rate of return on stablecoins in one of these platforms than you can in the bank? Like absolute beginner explanation.
All right, that's a very, very good question, and I'm not sure everyone really understands it perfectly. But the core idea is removing the layers in between us, right? So you're directly accessing these liquidity pools and opportunities. So all the middlemen, which through the banks and savings accounts, through all the passing the potato around, the hot potato around, you lose lots of actual abilities to directly generate interest through your savings account. So it's very important to understand that just removing all the intermediaries is one critical step of DeFi, and that helps you to get more juice than what you would get through a banking savings account. The second part is direct contribution to the ecosystem. The second part is right now all these platforms are competing with each other to be the liquidity kings, right? So they're incentivizing through their own tokens and other possible opportunities so that they can win the battle of liquidity. So on top of that, you have that natural competition where people want to be the winner, so you get an extra incentive on top of that. Those are the two specific points where I think there's more to it, but I think that's already a very high level idea on where this juicy DY comes from.
That was a great answer. And thank you, Martin, for that great question. I'm sure there's other people who benefited from that question. Tim, I'm just going to ask you one more question, and it is from the audience as well. It's Yield App offers 18%, but my bank offers 0.5%. What risks am I exposed to when saving with Yield App rather than my own bank?
Yeah, absolutely. Well, we don't really feel it's ever really a fair comparison, right? Because obviously, with any sort of investment, there is some inherent kind of risk. Obviously, your risk at the bank is what that is, but your risk at Yield App is obviously trusting a licensed fintech company and or kind of portfolio management system of how we're kind of managing our positions and our risk and our different diversification strategies on our side. And so how can we offer such high rates compared to it? And I think Alex actually touched on this. And DeFi for the most part right now is driven by subsidies, right? For lack of better words, and it's over incentivized. And so finding these opportunities that are safe and conservative, have been quite lucrative, and opportunities that we're able to very conservatively capture on a kind of a daily basis.
Great. All right, Gareth, any last words?
Well, they summed it up really well, but I think just to one point, why can't the banks? Why are we getting better yields in DeFi? The banks can give better yields. They can provide 6 to 8%. They just choose not to. It's not their business model, and that is the core of crypto, the core of tokenization, and permissionless protocols. The end user is the shareholders of banks. The end user in crypto is the token holder.
Right.
And that means we are aligned with the
Nicely
protocol
said.
and the success of the protocol, and what you extract economically from the protocol goes to the token holder. And that's what makes the difference.
Amen to
All
that,
right.
Gareth.
Yeah, and I think we could say that, maybe earning income in crypto is safer than the banks because of these three perspectives that we've just examined. So thank you, Alex, Tim, and Gareth. Really exciting stuff, and I'm thrilled and honored to have been able to ask you these questions. Thank you for all of your insights, and I look forward to seeing you at the conference tomorrow.
Great. Thanks,
Thank
Lisa.
you, Lisa. Thank you very
Yes.
much.
Thanks.
Cheers. Bye.